Hello guys, welcome to today's video. And the markets are recovering finally in the hope of ceasefire between the US and Iran conflict. I hope that that really happens because it is not only good for our portfolios but it is good for the overall economy of India because there is a real shortage of cooking gas, petroleum and fertilizer because these are essential things for the functioning of our economy. Okay, so today I want to talk about something which can really help you if you are an investor and you are going to now file taxes. So today I want to explain you tax harvesting in the simplest way possible. It is going to be a short video but a high value packed video, so do watch it till the end. Okay, so I'm not going to give you any complicated rules. I'm just going to tell you how this entire tax harvesting thing works and how you can potentially benefit out of it. Okay, so let's have a basic understanding of what is capital gain. I'm sure you know, but just to give a brief about it. See, when your investment grows, that growth is called as capital gain. And when you make a profit of more than 1.25 lakh rupees in 1 year on equity investments, you pay 12.5 lakh rupees tax on that amount. Okay, so above 1 year you have to pay 12.5 lakhs, 12.5% on your capital gains above 1.25 lakhs, that is LTCG. Below 1 year it is 20%. Okay, so tax harvesting is simply a way to legally reduce your tax bill. Okay, so how does it work? Part one is to book your losses which are notional losses. So let's take an example. Let's see if in your portfolio are there any investments which are showing a notional loss, meaning, for example, if you have invested 5 lakh rupees and currently that particular investment is showing 4 lakh rupees, which means that there is a 1 lakh rupee loss sitting in that particular investment and you are not doing anything to that investment, in the sense that you are not going to change that particular investment, so it is a notional loss. But if you sell this particular investment and book that 1 lakh rupee loss before 31st March, this loss will become a realized loss. Okay, and you can use this particular booked loss to cancel out any profits that you have made in any other investment during this particular year. For example, let's say in other investments you made a profit of, let's say, 4 lakh rupees and you booked a loss of 1 lakh rupee, which was a notional loss, and you took that 1 lakh rupee and adjusted it with the 4 lakh rupee profit that you had. On top of it, you have a 1.25 lakh rupees per year exemption on taxes for capital gains on equity investments only. This is not applicable for debt investments. It is only applicable to equity investments. So what happens is you will get an additional 1 lakh rupee benefit in terms of tax deduction just because you were able to book that notional loss. Now, this is just the first step. The next step is more important, so pay attention please. Okay, so the best part is you can immediately buy back the same fund in which you have booked the notional loss. For example, let's say you have a gold fund which you bought for 5 lakh rupees. Currently it is trading at 4 lakh rupees because gold did correct recently, and if you bought at the top, then you might have seen a correction in your portfolio or loss. So what you have to do is just sell off that gold fund and within just couple of minutes buy the same fund again back, which means that what you have done on the books is that you have booked a loss in the current financial year, but because you have purchased the same fund again with the remaining 4 lakh rupees or remaining capital, you are still invested in the same fund, which means that your investment is not getting affected, but you are getting the benefit of loss harvesting. This is how smart investors take the benefit of this kind of correction, especially during the financial year end. So your investment will continue as before, but you just were able to improve your tax position to a huge extent and save on taxes, which is again a return, right? Any kind of saving is a return, right? So the second part is what you have to do is every year, as I said, you get a exemption of 1.25 lakh rupees on long term profit on equity investments, which is completely tax free. So, and this limit will reset every 1st April. So most people never use this particular benefit. So if you have an investment which is in profit, especially equity investment, and you have held that investment for more than 1 year, all you can do is sell enough quantity or enough units just to realize 1.25 lakh rupees profit, okay, and book that 1.25 lakh rupees profit gain. On that gain you don't have to pay any kind of taxes, and then buy back that same unit or same fund again back immediately. So your cost price will reset for today's price, and when the investment will grow further in the future, you will have less taxable gain built up in this kind of process. So you took the benefit of loss harvesting, and you took the benefit of 1.25 lakh rupees exemption per year on the equity investment. So this is pure tax optimization for your investments. And if you keep on doing this every single March, over the many years, you will see that the tax saving that you would have done will actually compound to a significant number, and this is a completely legal and ethical system which is done by most or all of the smart investors. Okay, so I'll give a final example just to give a more clarity on this concept. Suppose you invested 10 lakh rupees, now it is 15 lakh rupees, you have a 5 lakh rupee long term gain, which means that you have held that particular position for more than 1 year. Without tax harvesting, when you eventually sell everything, you will have to pay 12.5% tax on 3.75 lakh, which is roughly around 47,000 rupees in taxes. With harvesting, every year you redeem 1.25 lakh rupees of gains tax free and reinvest in the same scheme. Over 4 years, you have cleared the entire tax gain. Okay, so this is how this entire system will work. The investment will be same, returns will be same, but you will be able to save thousands of rupees in taxes just by selling of tax exemption or selling of loss making units and quickly buying back again, right? So now there are 3 things to remember before you do this. First is only sell investments that are held for more than 1 year to gain harvesting of the losses. Short term gains are actually taxed at 20%, which is much higher, so you should not sell any kind of units which are under 1 year. Okay, second thing that you have to remember is you have to invest or reinvest immediately in the same fund so that your investment continuity is maintained. You should not wait, because what will happen is markets will move, and when markets move, then you might miss out on any gain. If there is a loss, that's a different story if the NAV falls down, but it is highly advisable if you sell today, buy the same units back tomorrow or day after tomorrow maximum, so that you don't really have to take an impact on your NAV. And the third thing is that obviously you have to do all of these activity before 31st of March, because only then you will be able to make all of these records in current financial year. So that is it. This is tax harvesting. I hope that you found value in this particular idea, and you might be able to implement it in your portfolio. If you want to know whether your specific portfolio has this kind of tax harvesting opportunity in your current investments, and you are confused about whether what you should do basically, then you can book a free portfolio review with us at Auris Wealth. Okay, what we will do is we will look at your current portfolio, your current goals, financial goals, and based on that we will help you to optimize your investment portfolio. And at Auris Wealth, we are a 360-degree wealth services firm. We provide all kinds of wealth products which are specifically tailored for you and your family based on your goals. Whether you are a business owner, a doctor, or a working professional, or an NRI, we specialize in all of these professions, investors, where we understand their needs, their family needs, and tailor their investment portfolios based on their specific requirements. Okay, so this is a free portfolio review. We are not going to sell you any product. There will be no pushing or any kind of follow up kind of thing from like just how bank RMs do, right? Once they get your contact, they will start calling you, sir, kuch investment karo, kuch investment karo. So we don't do all of that. We believe in 100% honesty and transparency, because we believe that your wealth growth is our benefit, because the more your wealth will grow, the more you will be associated with us, our company will also progress. Okay, so book the free portfolio review. The link is in the description box below, and do this before 31st March if you are looking for this tax harvesting opportunity. And thank you. Of course, if you like this video, do give it a thumbs up, share your experiences or your thoughts in the comment section below, and share this video for sure in your friends and family WhatsApp group, because this information will be very useful for them as well. Okay, so thank you so much, and do subscribe if you have not subscribed yet, and I'll see you in the next video. Goodbye.